and I'm joined by Mike Chupka from Power Options on the East Coast. How's it going there, Mike?
Oh, things are going pretty well, Kurt. Of course, we're been busy here the past couple days as expected, only because we're coming up to the third Friday of October. So we're here in expiration week, and customers with different questions about evaluating adjustments and using the portfolio tools on Power Options to track and manage their accounts and other things as well. So it's been pretty busy, but it's been a good week so far.
Very good. Very cool. Well, I see that the room is still filling up. We've got 30 attendees, but we've got 46 registered, and I expect that we're going to see more and more here in the next few minutes, particularly because sometimes folks don't register until the very last minute. I'm kind of excited today, Mike. We're going to be sharing a method, just one of the many radioactive trading methods, but we're going to be showing a way where it might be possible to call the top.
Okay.
And when I say that, I don't mean that I'm blessed with some kind of precognition, some kind of clairvoyance that no one else is. But what we are going to be talking about is how it may be possible to capture movement of a stock as it's going up and also capture movement of a stock as it's going down. And the net of that can give you the same profit. So kind of cool. All right, Mike, I'm going to ask folks to introduce themselves. I thought we'd kind of go skimpy, kind of go short on our introductions. I'll just make my introduction really fast. Hi, my name is Kurt Frankenberg. I lost a lot of money doing things wrong about 12, 13 years ago, and made up my mind to figure out what it was that the hedge fund players were doing, and learn how to stay out of trouble, at the same time position myself for good gains. Started a blog about it, and eventually some folks asked me if I'd written a book, and I said no. But I would if you really want me to. And we had pre-orders of several $1,000s of my book, which is now called The Blueprint, back there in 2002, 2003 time frame. So it's undergone 11 revisions, and today we're going to be talking about two of the techniques from The Blueprint, which is now has 11 different methods. So, Mike, real quick introduction from you, and I'd like our guests to introduce themselves as well.
Yeah, I'm the Director of Education here at Power Options. Power Options is, of course, a patented suite of search and analysis tools designed for self-directed options investors. I've been working with Ernie Zarena and the Power Options team for about 10 years now. And about 4.5, almost 5 years ago, we got connected with Kurt. He was actually a customer of Power Options, and he called up for a coaching session to learn how to use some of the tools. And when I first saw what he was searching for and what he was attempting to backtest, I told him honestly that I appreciated what he was doing, that he was limiting his risk with this unique married put setup as a starting point, but I was concerned that he wasn't going to make any money, that he was going to need the stock to move too far to realize any profit. And, of course, Kurt invited me to join him for his live presentations that he was doing at that time, just as we do now, and he invited me to show me exactly how he makes money with these positions. Well, I was so impressed by it. I've been trading options for 6 or 7 years, had my foibles with covered calls and my experience with naked puts and calendar spreads, straddles a little bit, strangles, also with credit spreads and the iron condor positions. And I was so impressed with the techniques, and I invited Ernie, who's been trading for 25 years before he created Power Options 15 years ago, to watch Kurt's next presentation, and Ernie was so impressed that we decided to partner up with Kurt, and we've enhanced our tools on Power Options, the married put tools and the portfolio tools, to work with radioactive traders as well as other strategies as well. But honestly, at any given moment over the past 4.5 years, my personal trading account has been comprised of about 45 to 55% of my invested capital is in the radioactive trade. So I'm, not only one of the webinar co-hosts, I actually trade this in my personal account with some other strategies, standard collars, and a few credit spreads on the broad-based ETFs and indexes. But over time, the radioactive trading techniques have been more successful for me long-term than the almost 2 years I traded covered calls, my 2 years experience trading naked puts, for example, and also my brief stint, maybe just 1.5 years or so of trading calendar spreads. I've had more success doing the married put techniques and retaining most of my capital while still earning profits than I had with those other strategies.
Very cool. And the collars, though they're not radioactive trades, they do follow some of the radioactive trading principles. So
that's true.
Yeah, you probably end up doing more than half of your account in radioactive ways.
It's probably closer to 60 or 70% if we include the standard collars, maybe 70 to 80% actually.
Yeah. So, and even credit spreads, it's all about limiting risk. I'm sure you don't do credit spread with your entire account at risk. You do
no, only 10 or 15% of my invested capital's in this credit spreads, and I only trade credit spreads against broad-based ETFs or indexes. I don't do them on standard stocks, for example.
Right, so something that moves a little slower, right?
Mm-hmm.
In case you need to make an adjustment. Very cool. Well, you're following all the risk management principles that.
I am.
Yeah, that make radioactive trading what it is. And Mike, I'm very pleased to be a part of the team there at Power Options. So, folks, that's it for introductions. We didn't want to burn up more than 5 minutes doing that, but I would like for you to introduce yourselves, okay? And what that means is we'd like to know what kind of options plays that you're doing right now, and what kind of success you're having with those. And let me go ahead and launch that poll here. While that poll is populating, Mike, I'm going to remind everybody that there are 2 of us on the line here, so it's possible, for you to be posing questions and for me to be talking while Michael is answering a question, or for Mike to be talking while I'm answering a question. But it'd be more efficient, it'd be better if you jot down your question and wait until the times that we're going to have 2 places where we pause, until those times where we're going to be able to take a few questions. Okay? Mm-hmm. So,
and we did have one question already come in, and I'll just share it. Yeah, I'll share it with everyone. It's a good question. Cesar wanted to know, is it possible to watch older presentations or previous webinars presentations? And yes, if you go to RadioActiveTrading.com and you click on the free webinars tab at the top of the page, that'll give you access to the full Radioactive Trading webinar archive. So you can watch older presentation. There's some things there with specific titles that might help you with the questions you might have about radioactive trading. Don't do it now, though. You're live now, and that's better, but don't do it now. But yes, right, you can watch you can watch archive webinars at any time. Just go to RadioActiveTrading.com and click on the free webinars tab.
Super. Okay, now, Mike, we made available that folks could vote in more than one category.
Mm-hmm.
So it's going to add up to more than 100%. And let me go ahead and share the results. We got about half still doing the what I call the gateway drug, still doing covered calls or their cousin, naked puts. I call it the gateway drug because it's how I got started trading options. I think it's how you got started. It's how most people get introduced to options trading, although some folks qualified just right away for long calls and puts and things like that. Usually, the way that you begin to trade options is that you've been to one of these weekend seminars, or you've been to some online training or something, or even just have tagged along with a friend and you've learned about how to rent out your stock. So that's roughly half of our audience. More than half are doing long calls and puts. Very good. 33%, almost exactly 1/3, are doing verticals, diagonals, and condors. They're doing combinations. They're doing spread trades, which is cool because a little bit later we're going to be showing some really interesting variations on the theme with spread trades, including a spread trade that has no risk. So that's kind of exciting. And then 14% say that they're not trading options at all, and that's okay. We love you. We're glad that you're here. You're still going to end up picking up some things. And I think you're going to really dig it. If you're not trading options yet, this webinar may convince you that it's possible to trade options and trade them safely when you understand a few principles. So, very good. Let me go ahead and hide that, and I'll tell you what we're going to tell you, and then I'll tell you, and then I'll tell you what we just told you, following the Toastmaster tradition. Folks, in this webinar, I'm going to make 3 bold promises. Okay, the first bold promise is this. I'm going to show you the solution to a big problem facing buy and holders today. Okay, I'm going to just show you the solution to a big problem that's facing buy and holders today. Okay, in fact, I'm willing to bet that you're going to take a look back and wish that you had thought of it sooner. I'm willing to bet that. Number 2, I'm not a betting man either. I'm not a gambling man, but I'm willing to bet this. Number 2, I'll show you a riskless spread trade, which is done at a credit. Normally, a credit spread involves risk, but remember, I said that this would be a riskless spread trade. Really interesting, riskless spread trade. It's possible to take income from your stock without necessarily selling it, or without necessarily limiting the upside, and that's going to be a real breath of fresh air to the folks doing covered calls, because what's the biggest complaint besides not having your losses covered? What's the biggest complaint, Mike, on covered call trades?
Well, we guessed the right direction. We picked the right stock. I actually have an issue like this. This expiration. I'm sorry, folks. Coming up, where I did a standard collar, similar to a covered call. The gain was capped. I did a standard collar, and the stock exceeded my expectations. But you look at the problem. I bought stock at 32.40, sold the 32.5 call, and the stock went up to 37. Now, how do we take advantage of that extra increase? Well, without putting more money in, you really can't. I mean, there are ways to adjust it, but you picked maybe the kind of right situation. I'm going to make my 3% or so. I should take that and be happy. But to try to realize more of that increase, that over 16%, 17% increase in the stock, I'm not really realizing it.
Right. So you sold the 32.5, and the stock went up to 37-ish.
Mm-hmm. Correct.
Yeah. Oh boy. So you didn't get to realize the upside on that.
Mm-hmm.
Well, thankfully, you don't do all of your trading that way. But
nope.
But we are going to show a riskless spread trade that makes it so that you take an income, but you don't necessarily risk the bad feelings of having to give up a stock at 32.5, where the stock itself went to 37. So number 3, this is your favorite, Mike. I'm going to show folks how to ratchet up their exit point. And you did this very happily with one stock, where you continued to ratchet up your exit point to where you were always guaranteed to make a profit.
Yeah, I had a locked-in profit. Even if the stock retraced, I was guaranteed to make money on the downside. No matter what happened, I still had unlimited upside.
Yeah, and that's really exciting. Okay. And we're not talking about a trailing stop-loss order. If the stock had gapped down, you would have just said, oh, hallelujah, I still get out with a profit. And it's something real that guarantees a better exit. It's not a stop-loss order, okay? So how cool is that? So those are the 3 things that we're going to be doing. What I'd like to do right now is just take a baseline reading, because I just made the claim I just made the claim that I'm willing to bet everybody's going to take a look back and say, man, I wish I'd have thought of that sooner. I wish I'd have been doing that last year.
Mm-hmm.
So I'm going to ask, we've already asked what kind of options trading folks are doing, okay, and here's the results of that. All right, I'm going to ask, how happy are you with the results from that trading? Okay, and if you just got out of a seminar like last week and you had one successful trade, please don't participate in this webinar. I mean, participate in this webinar. Don't participate in this poll.
Right.
Do participate in this poll if you've got a track record where you've been trading for 12 months or more. Okay, many of you maybe several years, but let's just look at the last 12 months only. Okay. And are you happy with your performance with those strategies that you just shared with us that you've been doing?
Mm-hmm.
Okay. Again, only if you get about a 12-month track record. Mike, this is shaping up almost exactly the way we expect it to with the Pareto distribution. What's a Pareto distribution?
Well, it's a common distribution that you see when you do any type of survey of land ownership, wealth ownership, for example, where you commonly see an 80-20 split, meaning that 20% of those surveyed own 80% of the land or 80% of the wealth, where the remaining 80% own only 20% of the land or 20% of the wealth.
That's right. Let me go ahead and close this poll because it's been a minute. And this is actually did a little bit better than 80-20. We've got 72-28, okay? But by and large, we've got more people that are unhappy with their trading or have mixed emotions than are happy. The first 2 lines total 28%, and then the remaining 3 lines total 72%.
Mm-hmm.
Okay, so we're going to fix that. We're going to redo this poll and see, you know, a before-after kind of a look. Okay, so so now that we've got how happy folks are with their trading results, let's talk about the problem. The problem is that you don't know the future. Okay, it's a problem for me too. I don't know the future. I don't know what a stock is going to do. Okay, and for example, looking at this stock, now you know what happened because it's in the past, right?
Mm-hmm.
You know what happened. I know what happened. This is in the past. But if it were March 26th today, and we saw this nice little pattern forming here, this little cup forming here, now we could look into the fundamentals of the company. We could read the news. We could analyze this to death, you know, using all kinds of oscillators and MACD and, you know, Gann angles and Darvis boxes and all kinds of stuff. Okay, we could use Bollinger Bands. All right, but really this is the far right edge. We do not know what happens beyond this point, right?
Mm-hmm. Right.
I mean, that's the big problem. Okay, the big problem is. So now what? All right, let's say we do get in. Let's say we think we have a bullish sentiment. We say, okay, let's do this. And we get in, and then your stock begins to go up. Well, here's a problem, a big problem. It's almost as big a problem when your stock starts going up as when it starts going down.
Right.
And here's the deal. It's because we don't want to feel like a chump. And I wrote a couple of haikus about this, Mike. Here's one. If I sell my stock and it keeps going higher, I will miss the boat. Okay? Not cool. But this is a worse problem. If I hold it, I might give back my profits.
Mm-hmm.
Stock goes down the drain. See, the problem is if we still hold. You know, you see the stock go up and it's showing you a gain. You say, "Wow, that's great. Let's see how much more it does." And she retraces, like you were talking about.
Mm.
Well, if she retraces and we haven't done that that cool technique that we were talking about, right? We may end up getting a loss, even though the stock was showing us a gain. We got greedy, we stayed in, and we end up giving it back. Okay, so kind of poignant, kind of no fun, and that's the conundrum that we're faced with after we get in. We still don't know. I mean, whatever day it is, all right, we still don't know what's going to happen the following day.
Mm-hmm.
Don't know what's going to happen the following day. Okay, but what if you're able? Here we are with the far right edge. What if we were able to say, okay, look, if I'm wrong about this, I'm going to get out with a single-digit loss. But if I'm right about this, good chance I'm going to call the top.
Mm-hmm.
Now, isn't that the holy grail of technical analysis? It's to be able to say, okay, on thus and such, you know, on this day, it's going to hit its all-time high, and I'll sell right there.
Okay.
Wouldn't that be just kind of the holy grail to be able to say absolutely,
mm-hmm.
either on this day or either at this price, right? That's on this day is technical analysis, right? And then at this price, that's fundamental analysis. That's what all the analysts seem to do. They say, hey, you know, our target price for XYZ is $25.50, you know, and so when it gets there, hey, that's when we sell. Well, that'd be nice. It'd be nice to be able to call the top, but it doesn't always work in practice. Why hasn't this problem been solved yet? Well, so far we've only discussed two choices, okay? Fundamental analysis, which is, you know, that target price idea,
mm-hmm.
and technical analysis, which you look at the stock and you say, well, okay, looks like it's going to start hitting resistance here and maybe on this day, and so that's when I'll sell. Well, I'm here to tell you that there's another option, not to make a pun, but there's another option if you want to cut your losers short and let your winners run. And first of all, before I tell you what I found, what I discovered, I'm going to tell you exactly how to not do this, how to not cut your losers short and let your winners run.
Okay.
Mike, what are we looking at here?
Well, Kurt, what we see here is the common profit and loss chart of a static covered call, standard covered call position.
Mm-hmm.
And what we see here is that, okay, well, as we talked earlier, we have our capped gains, so the idea is, hey, It's alluring. It's sexy, Kurt, isn't it? We can buy stock and rent it out and make 3 to 6% per month, and you can do that month by month and compound it. Well, yeah, that's great, but what do we have on the downside here, Kurt? What is the issue here?
Well, there's all kinds of risk. It's difficult. Some brokers won't even allow you to set a stop-loss order on the stock because if you're short a call and then the stock whipsaws, if it goes down and you're called out and then it goes back up, well, you're naked on that call.
Yeah.
So that, they may not even allow you to place a stop order. And even so, even if they did allow it, a stop order does not offer very good protection.
If there's a common slow-moving market, yeah, stop loss can help you. If it's a sudden unexpected event or a black swan event, the stop loss will hurt you more than it's helped you.
Right. Yeah, folks that were trading on May 6, 2010 know all about that. Actually, you and I don't know all about that because we don't use stop orders.
Right.
You were working with the clients, and when the flash crash happened on May 6, 2010, you were humming along just fine, and no difficulties at all. I myself, I was taking a nap, and not to rub it in with anybody, but the thing is, we had our losses dialed in, our possible losses dialed in to single-digit percents, or in some cases 0.
Right.
We had 0 probability of loss because of our position. Now, the cover call position isn't that. This we can suffer a loss, but if we're right, we don't get to take advantage of the upside.
Right.
So not cool. Spread trades, same thing. You've got your loss limit dialed in, which is thankful. Okay, we didn't have that with cover call, but we do with the spread trade. Got a loss limit dialed in, but what else do we have dialed in?
Well, we've also dialed in a capped gain, Kurt. We do have a capped gain. This is a bear call credit spread, and let's say you and I were looking at a stock that was trading around $47, $46 per share. Well, we might decide, okay, I'm going to sell a November 50 call and buy a November 55. Now, if the stock's trading right at 49, hey, Kurt, both of our calls expire worthless and we keep our initial net credit.
Right.
But if the stock goes to $12 per share, we don't make any more.
Right.
We make our return, we keep our net credit, but we don't take any further advantage of the movement. The same thing, of course, is true on the bull side. If we were looking at a bull call debit spread or a bull put credit spread, if the stock shot off to the moon, went up to $100 per share, we wouldn't be taking advantage of that movement.
That's right. And the thing is there that if we want to be right about the direction, that's great. But if we're really, really right, well, we don't make any more. On the other hand, usually these kinds of spreads, if they go against you, it can be bad. There's a fellow right now selling a course where he talks about, get this, Mike, he calls it 100% gain if he takes a credit on a bear call spread, right, or a bull put spread. He takes a credit, and then he ends up keeping the credit. He calls that 100% gain because, after all, I kept 100% of what I took in.
That's true. But
how's that for wacky math?
It's against some margin, so it's not a true 100%. But we can. Yeah, we'll look at that.
Okay. Yeah. So interesting fella, and the thing is, what he's not mentioning is maybe you take a 40-50 cent credit by doing your spread, but if the spread goes against you, then you lose, $4.50, $4.60. And so, you have to be right 9 times out of 10 just to break even, and that's kind of difficult. Well, Mike, here's the crazy idea I got back in 2001, and I started trading it with real money in 2002 after doing a lot of exploration and back testing and things like that. And I didn't come up with the married put idea. The married put or protected put play has been around for a long time. But I am the fellow that wrote the Wikipedia entry. Okay, I am the fellow that has championed this cause, has been talking about it for more than a decade. And what's interesting is in mutual fund prospectuses, when you look at the mutual fund prospectus, every single one that I ever picked up informed me that the fund trader was going to enter into collars and married put positions.
From time to time, yep.
Yeah, from time to time. In order to, and I'm thinking, wow, these guys that steward millions, sometimes billions of dollars of the public's money, they're familiar with this, and they do this all the time. But when it comes to, private persons, we're undereducated as to how to use this. But here's the deal. If I put on a Mary put position, I have the stock. I also have a put that guarantees the floor, but does not set a ceiling. So, Mike, if we're right about the direction of this stock, I would say that it is safer, certainly, if we're wrong. But if we're right about it, this is the only graph that we've looked at that has an unlimited upside potential. Is that preferred, do you think?
Yes, it is. And if we're right, we want to allow those extra profits to move up. We don't want to see our stock move up 12, 15, 20% and be locked into a 3% gain. Right.
So here's the structure of a radioactive profit machine, and we're going to also talk about bulletproofing. Right? Okay. All right. So in our example before, we're looking at RCI shares trading at $38.95, and we actually I actually came up with this RCI example because of a fellow that worked there that had shares from there at a very low cost basis, and he wanted to insure them, but he didn't want to pay anything for the insurance.
Right.
And we actually showed him, how that would be possible, how it would be possible to really protect your gains. And we're going to go ahead and use that same example, but instead of using it as a way to protect gains, what we're going to do is we're going to pretend like we're getting in at this price on this day, okay? And then try to call the market top. Check this out. First, we buy the stock, and we also set up an insurance policy. And this insurance policy, we're not going to spend anything on. So watch how this works, okay? Here it is, March 26, 2012, and RCI shares are at $38.95. Now, the fellow that provided this example, he actually had these shares already at a cost basis of $27 and change, okay?
Okay.
So we were showing him how to protect his gains and not pay anything to protect them. But if we were just getting in on that day, we would be spending, for a July 2012 $40 put option, we'd be spending $2.90. Now, Mike, when you saw this kind of setup initially, what did you say to me?
Okay, well, I appreciate
4 years ago.
Yeah, I appreciate the fact that, okay, you've got a 40 put. I see that you've got a stock trading at $38.95, but you're increasing your cost to $41.85. So I can appreciate you're sort of limiting the risk here to $1.85. We'll show that in a minute. But really, I mean, you're going to need the stock to be trading at $41.95 before you make a dime. That just seems like too large of a move, Kurt. It just seems like if you've expected that movement in the stock, maybe a better strategy, there'd be a different strategy that you could use.
Right. And a lot of folks would say, well, shoot, Kurt, why not just buy the stock? Now, here's what you said. You said it's $41.85 cost basis, so you're not making a dime until the stock gets to $41.95. Well, Mike, you now know that isn't true because of the radioactive trading adjustments that we do in the context of this. You know that. But not everybody viewing knows this. Here's the deal. The stock never got to $41.85. It never did get to $41.85, but it was still possible to profit even with this setup. It was still possible to capture, in fact, as much stock movement as was possible to capture.
Right.
Watch this, okay? First of all, we want to talk about the guaranteed exit. The guaranteed exit is guaranteed by the put option. I can get out at $40 no matter what happens to the stock. Really, what's at risk here is the difference. The difference between what I've spent for the stock and the put and the strike price of the put. So, $1.85. When you set that $1.85, against the $41.85 that we've invested, then we've got our maximum possible loss set at just 4.4% of the capital that we've got in there. Now, Mike, 1 year, I use this example a lot because I just love the contrast, okay? 1 year, you had a huge loss of 4.5%. That was the biggest loss that you took that year using the radioactive trading techniques, correct?
That's right, yeah. That was back in 2010, essentially. I'm sorry, 2011. Right. I'm sorry, folks, 2011. Oof.
2011, okay. So the stock itself went down by half.
Mm-hmm.
The stock itself, caved, it collapsed, but your loss was limited, just like what we showed here with the structure. It was limited down to single-digit percents. In your case, it was 4.5%. Now, also, you took a gain that year on another 300 shares of stock plus 3 puts, where if you count all the adjustments and you count how much you put into it at the beginning, and not just the stock but also the put option, every expense that you had, you still end up taking in 59.8% on
Mm-hmm.
that, on not just the stock but the stock and the put. So was that okay? Was it okay to take a loss of 4.5%, but then also take a gain of 59.8%?
I was very fine with that, Kurt, actually.
See, that illustrates the point of cutting the losers short and letting the winners run. So anyway, here we are at the starting point, because we don't know the future. We're at a starting point where the most we could possibly lose is 4.4%, okay? That's where we begin. But I know that some folks are saying, hey, wait a second. You said you weren't going to spend anything on that put option. Oh, okay, well, fair enough. I did say I wasn't going to spend anything for the insurance, and the fact is you have to pay something for a put option, but how about we use a nested spread trade? We're going to use a spread trade that finances the cost of the $2.90 put option. Looky here. If we were to, it's March 26th, right? If we were to sell the April $35 call, we would pick up $3.60 of premium. And if we were to simultaneously buy the $40 call, it would cost 30 cents. And so we have a net credit of $3.30 in a bear call spread here, $3.30. Now, Mike, what is the risk of the bear call spread?
Okay, in this particular one, you've got a 5-point spread, meaning the risk is if the stock goes above 40. You are doing this a specific way where you're actually, at this point, you're kind of using an in-the-money call. So you've got this high credit of $3.30, so you're really only risking $1.70. But that bear call credit by itself has under a 50% probability of being successful. Now, I said bear call credit by itself. So normally you don't see this kind of setup where you're taking a $3.30 credit and you have a 5-point liability or $1.70 at risk.
Right.
But that's your risk. If the stock moves up, you're going to have to pay $5 to close the position, so you're going to lose $1.70.
Right. Okay, so $1.70 is my maximum at risk in that position.
Mm-hmm.
But in order for me to take that $1.70 hit, the stock has got to go up to $40.
Right.
Now, here's something interesting. As the stock climbs, okay, and its value goes up $1.05, right?
Yep.
The put option comes down in value less than $1.05. And what that means is that even if the stock goes to right at $40, my put comes down in value and my stock gets delivered, I'm still going to lose less than if the stock had completely bottomed out. And I'm also going to still have unlimited upside because it's like I'm paid to own this long call. Okay. Now, Mike, here's where I want to switch over and change you to the presenter so that we can look at RCI today and just get a feel for what it is that I'm talking about.
Okay.
So let's do that. And let me go ahead and change it over to you. And Mike, do you have the RCI setup all figured out already?
I've got something, yeah, but we're going to work through it together. That's the best way to go. Okay.
Okay.
All right. So let me see here. Let me make sure the audience is seeing my screen here. The Power Options tools. Yes, they are. This is the custom spread tool, or what's known as the profit and loss chart. Now, when I entered this at the beginning of the presentation or close to it, RCI is roughly trading at $41.60. We might be able to buy 100 shares of stock at $41.60. And I just chose the April 45 put at 5.30. It's a strike or so in the money. And I wanted to make sure when I went to the View Options link, I chose April. So I want to make sure I'm at least 150 days out in time. And the choice I have here is April. It's 186 days out. Now, what does that look like, Kurt? Let's scroll down here. And what we're taking a look at is there's our profit and loss chart if we open this position today, buying 100 shares of stock, RCI at 41.60, buying the April 45 put for 5.30. So my total cost basis in the position, I'm going to highlight this, is 46.90. So I effectively have a cost per share of $46.90. Now this does show us that the break even is 46.90, but that's here. That's the break even at expiration. If I hold the position all the way to April expiration, make no adjustments, I would need the stock to be trading at 46.90 to realize any profit, or break even, excuse me, folks, break even. But
yeah, but that's only at expiration.
And assuming I made no adjustments. Now.
Yes. Okay, so two things you've got control over. You've got control over whether or not you get out before expiration. Get out before expiration if you want to. And you also have the ability to make a decision to, you know, I think I'd like to do some adjustments. So let's erase what we have up there.
Well, before we jump into that, I want to point out two quick things, sir, two important things. And what we wanted to notice, of course, is our risk would be 4.1%. 46.90 in, we've got the 45 put, we're risking 4.1% infinite upside. Now what we also show just on this chart is over here we're showing the profit and loss on 117. And what that is that's the halfway point. But notice, even though our break even is 46.90, at the halfway point, halfway between now and expiration, in this area here, roughly at about 44.50 or close to 45, so before 45, we may be able to realize a profit on the position. And we just wanted to bring that up because, yes, the break even is 46.90 or the investment's 46.90. That's the break even all the way at expiration. But we don't have to wait till then. We can realize a profit well before the stock's at 46.90 on this position.
Right, yes. You could be profitable well before then. Okay. Mike, I want to skip October because that expires in just a few days. So let's do November. Okay.
There we go. So let's pull up our collapsible chain.
Yeah.
Ugh. Okay.
That's not as happy as I'd like it to be, but let's try it anyway. Let's sell the $40 call and buy the 45. So it's a bear call spread.
All right. So I'll just click those to add them, and down below it's added it to our next available line. I'm going to choose to sell the call. One contract. We're going to buy the call. It's going to give us the natural bid of 175 for our 40 call and the natural ask of 30 cents for our 45. Okay, here is the before picture. Remember that? Limited loss, unlimited risk. Now let's submit that.
4.1% at risk. Yep.
Okay, now here we go with, there we go, with our new position, Kurt.
Okay, so it ends up being kind of a little check mark here where we still have unlimited upside. If the stock goes down, look over there far to the left. Okay, if the stock goes down, what could be the most that we could possibly lose?
Well, it's going to be about $48, Kurt.
Okay, $48 on a $4,500 investment. So about 1%.
Yep.
Okay. And the upside, of course, is unlimited. All right. And then the only problems that we have is this dip in the middle, which we have management techniques for. Okay. So the worst possible scenario is that that thing collapses. I mean, it finishes right at $45 a share. Now, we had a more favorable situation for RCI back on March 26th.
The call premiums were higher. The stock was closer to the strike prices of the call that you were selling, so it was giving you a little bit more oomph on that position. And what ended up happening in the position Kurt's talking about is that in that view, with the little check mark here, yes, the risk was still at about this point, the long call strike price, but down here, the position was bulletproof. So if we collected another 50 cents of profit on that short call, we would see a bulletproof position here. Let's just do that real quick. So it can't be done, but let's just say we did get $2.25 for selling that November 40 call right now and still bought the 45 call at 30. What would that look like? Wouldn't be able to do it right now, but see, that's more along the lines of what we were looking for, Kurt.
Very good. And let's do something else, okay? Slide up there again one more time.
Sure.
And let's select, clear the bear call spread that's in there, please.
Done.
Okay. And let's open up the options possibilities here. Let's look at November. We may not want November. Let's look at it. Okay, we don't want it. Let's look at January. All right, and we still don't want it. Okay, never mind. Very often it's possible to sell at a higher strike price, okay, where we would sell the $45 call and buy the 50.
Mm-hmm.
Still have the unlimited upside, but have a spread trade that has zero risk.
Oh, okay. Let's try something real quick here, just a very quick example. Let's see here. There we go. I want to go here. April again. I'm going to go here. Let's see what that looks like very quickly. I just know that APA has
the stock and one put option.
Not bad. Okay, 6% at risk, 95.70 invested. So it's buying shares of Apache at 87.10, buying the April 90 put for 860, gives us a 6% risk with our infinite upside. Now let's go to
Mike,
yes.
Mike, can let me write those numbers down. Can you scroll down again?
Sure.
Okay. So 570 at risk, 570 cash at risk, and it's 6% of the underlying.
Yes.
Of the whole married put play.
The 95.70 invested. Yes, sir.
Unlimited upside. Okay, now let's add a bear call spread to it and see what happens with the bear call spread.
I don't know if this is going to give us what we want. The 87.5 is at 237, and 92.5 is at 63. Don't know if that doesn't really do it, does it?
Try the 87 versus 90.
Okay.
And see what happens. This is why I love the Power Options platform, because you can look at what's going to happen. Now, Mike, all of a sudden, look at that maximum risk. It had been 570. Now it's been lowered by nearly $100. It had been 6%. Now it's only 5%.
That's right.
And either way, I get to keep that $100 is generated by the call spread.
Correct.
Right. Let's scroll up. Let's do another play. And folks, bear with us, okay? Because we don't know moment to moment what the market's going to be doing, but let's do the November 90.9250 or 90.95.
Okay, so November, sir. Going to hit 90.
Yep.
And you want the 95 or the 92.50, sir?
Let's do the 95. 90
Very well.
Versus 95. See what happens.
That's something I'm more keen on.
That's exciting, okay? Because, again, the maximum risk is it had been 570, now it's 474. We've collected $1 credit for doing that bear call spread. We've collected $1 credit for doing the bear call spread. If the stock stays flat, we're going to keep that dollar, and we could do it again month after month. We could do it a couple of times. If the stock takes off, well, we have a position that takes off with it. Okay? And that's a happy, happy thing. And what's really exciting here, Mike, is let's scroll up again and just take out the married put.
Sure.
The married put gives us unlimited upside and also downside protection. But if we submit that, and if we were just doing bear call spreads, boy,
that's common.
We'd be picking up $98 and have the or
it's $102.
Yeah, and then have the privilege of, geez, maybe you'll have to pay back $398.
Right.
I like the idea of doing a bear call spread, and if the spread goes against me, I still win. Still win. And if it doesn't go against me, well, I win again. I get to keep the credit. So there's the idea. So Mike, let's go back to my slides. I'll go ahead and just yank the screen from me unless you had something else to share.
No, that's good. We're good. Let's get back to our presentation there, and you've grabbed the screen from me, so just go ahead and select to show your screen, and we are all set back on the slideshow, sir.
Very nice. Okay, so the reason that the bear call spread can hurt you at all is that you'd be called upon to deliver the stock and you don't have it. But the thing is, we're doing this in context of, hey, we own the stock. So the risk that's presented by the bear call spread disappears. Rather than having to buy it on the open market, I've got it in my account. Okay.
Right.
So and the other thing too is if the stock keeps going up, well, geez, we deliver at the lower strike price, and our upper strike price call, it's like we've been paid to own that call.
Yeah.
It's like we've been paid to own that call, and so the stock keeps going up, okay? All right, so the $2.90 for the put option. Remember, we bought the stock for $38.95. We paid $2.90 for the put, and so the $2.90 for the put option is financed by the $3.30 credit taken from selling the bear call spread. So essentially, it's like we've been paid 40 cents to insure our stock against loss. If the stock goes down, well, it'll actually be kind of a good situation because our net cost basis for the stock, okay, and the put ends up being, $38.55, and if the stock goes down, we own a $40 put.
Right.
We're bulletproof, okay? So here's the deal, though. What's the worst thing that can happen when you have a bear call spread in place?
Stock goes up.
Okay, so we're going to talk about that. We're going to use a management technique because, after all, we don't know what's going to happen next, okay? So we use a management technique because the stock went up, and therefore the bear call spread closes against us unless we do something to manage it. For example, we could buy to close the April $35 call, or we could simply rebuy the stock at $39.66 after delivering it for $35. So it's at any rate, either way, we're spending $4.66, okay? But that's okay, because if you look at the next month, you might also, again, sell to open a May 35 call and buy to open a May 40 call. This is rolling the bear call spread. Here, getting filled at even the worst, okay? See all that bid-ask spread difference there, Mike, the 440 to 5 and the 55 to 90? We could get filled at a better price, wouldn't you say?
Oh, sure. You might be able to get the midpoint there, for example.
Yeah, we could certainly get filled at a better price. But even if we got the natural bid here on the sell and the natural ask here on the purchase, it'd still be another $3.50 credit. Okay, so this is rolling. A lot of folks don't realize that you can often roll a bear call spread at a credit. And in this case, we didn't roll it at a credit. But even if a credit's not taken, it can be advantageous to close the first call spread and reopen the next month out. Rolling the spread delays the delivery of the stock. Meanwhile, we've still got a put in place that's protecting the stock. Okay? And the stock going up or down in this context guarantees a gain. If it goes way up or if it goes way down, we're going to have a gain. Okay? Here's what did happen. Expiration Friday, the stock went to $35.21. Now that's no great shakes for closing. We can close that May $35 call for 21 cents, right?
And that's right.
Okay, and so here's an accounting so far, because I've always called the radioactive profit machine. It's a married put, yes. Okay, but it's a married put that's put together in a very special way where the put option is far away in time. And then we treat it as a small business. A small business has inventory. It has accounts receivable. It has accounts payable. It has this accounting ledger here. And here's what's going to happen. We took in $3.30 for April call spread. Right? We also paid for some insurance, right? We had to manage that April call spread, but then picked up another $3.50 for doing the May call spread. If we're going to manage the May so that we can hang on to our stock, if we're going to manage it and hang on to our stock, here's the total spreadsheet so far. We've taken in a credit of $6.80.
Okay.
Paid out debits of $7.77. Okay? And this is all surrounding the ownership of our stock. So the net of $6.80 in and $7.77 out is 97 cents. Well, whoop-de-doo, this is kind of cool because we're looking at 97 cents added to the cost basis of our stock. And the stock's original cost was $38.95. Okay, $38.95 plus all the stuff we've done means that we still own the stock and we still own a put option that's a $40 put. Mike, we're bulletproof. I mean, what's my risk now that my cost base is $39.92 and my strike price of the put with months left in it is at 40?
Well, you've got an 8-cent guaranteed exit, meaning you're going to make 8 cents. If the stock dropped to $1 per share, you'd still profit 8 cents, but your upside doesn't have anything capping it right now, does it?
That's right. The upside has no cap. Okay. Now, here's the deal. The stock kept going down after this. So the 8-cent gain is nothing to really write home about. But then again, we're not finished with the story either. Okay? Because all we've done is we've shown income method number 6, the bear call spread. We've shown that twice in the context of the radioactive profit machine. Shall we show them the secret sauce?
Oh, that's what I think they've come for. Well, they came for a lot of things, but that's one of the things they have come to join us for, Kurt.
Okay. All right. Now, before, if we had been trading just the plain stock and we ignored options, okay, this is for the folks, the 14% of our audience that said, I'm not trading options at all. Before the options, okay, if we just bought the stock at $38.95 and it goes to $35.21, that would be a loss of $3.74, okay? But now we've got stock at a $38.95 cost basis, okay? And it's like we've spent 97 cents for our insurance policy, you know, after all the income methods. It's like we've spent 97 cents net, okay? And so we actually have a small gain in place, but that's not that exciting. What's exciting is there are other income methods. In the blueprint, my book, we discuss 11 different ways to take money out of a married put position. There's 11 different ways that I've discovered and proven in my personal account, okay, that you can take money out of a stock without necessarily selling it.
Right.
Okay? And we've only shown one of the income methods, but we might also have done another, and here's how it goes. Income method number 4 actually doesn't take a credit. It takes a debit to do it. On April 2nd, 2012, the RCI shares went above $40, and remember, the $40 put is what we were holding, right?
Yes.
Okay. Now, when we bought it, when RCI was at $38.95 and we bought it, that put was in the money. But when the stock goes above 40, it changes the situation. We don't have to get into all the details of why and how we do this, you know, in the blueprint and so forth. But the blueprint shows us that...
It discusses all the details, yes.
Yeah, it discusses all the details. It shows us income method 3 and 4. Income method number 4 would have been a great thing to do here because what we do is sell to close the July $40 put option. Now, the July $40 put option cost $290 before, right?
Yes.
Now it's down to only $170. But I want to add something. It's down to $170 because the stock went up and we own the stock. So that's a good thing. Now watch what we do to capture some of that upturn. We're going to capture that upturn by selling our put, our $40 put, and in its place buying a $45 put. Now, Mike, if I didn't own stock and I didn't already own this put, what would you call this? Selling the 40 and buying the 45. What would you call that?
That would be a bear put debit spread. We'd want in theory, want the stock to stay below the strike price.
Right. Okay. Bear put debit spread where we spend $370 and we're betting that the stock is going to go down below 40. Okay. All right. Well, we spent $370, but let me explain something. We've also raised our cost basis. See, a lot of folks are saying, oh, wait a minute, why do you want to add to the cost basis? You're already spending too much. you spent $38.95 for the stock, and then you spent $290 for the put, and now you want to add another $370 to the position. What is wrong with you, Kurt? Okay, well, let's think about it for just a minute. Okay? The price had been $38.95. The price of that original put we financed by using other income methods, right?
Yep.
So when we go to sell it, it's going to be a good thing. Okay, here was the situation before income method number 4, but when the stock went above 40, then the put options, it was available to sell sell the 40s and get the 45 and spend $370 for that.
Right.
Here's our cost basis. We got the stock, we've got the original put financed, right? And we're going to add another 370. So we end up with a total invested amount of 43.62, but we raised the put to a $45 put. Aha! The put is now a $45 put. What's our risk now, Mike, as the stock is heading up?
Now we're even more bulletproof. Our guaranteed exit is now that $1.38. So if the stock collapses now, if it drops to $2 per share, we're still going to make $1.38, but we still have that unlimited upside.
Yay! Okay. So that's the idea of combining those two. Now, and there's still some time left to expiration, but you know what? We're going to just go ahead and get out. We're going to go ahead and allow ourselves to be assigned with that bear call spread. Here's the deal. Remember before when I said, hey, if we had a time machine, if we could get in on March 26th and know for a certainty that if we held till April 17th, we could get out with a movement of $1.63, we would do it, right? I mean, if we knew certainly that we could get in here and get out there, we'd do it, right?
Yes, that's right, Kurt.
All right.
I would do that.
Yeah, every day and twice on Sunday, you know, if I knew the future. But and here's the actual return. It's $1.63, and when you set the $1.63 against the $38.95 invested, that's a 4.2% profit in what is it? About 3 weeks. Okay, exactly 3 weeks. Okay, now that's the stock only, calling the top. Okay, but here's the actuality of the situation. When we close on May 18th, and I'll give all the numbers here in a minute, okay, and I'll give the total accounting, all the accounting here. But when we close on May 18th, when we sell to close the stock and sell to close the put option and so forth, you know, on March 26th when we got in, it wasn't $38.95, it was $38.55 because, you know, we paid for a put and we also sold the bear call spread. Anyway, it was a 40-cent credit, right?
Right.
Right. Okay. So instead of our cost basis being $38.95, our cost basis is $38.55. We don't make as much profit, but then again, when you divide this profit by the investment, it ends up still being a 4.2% gain. Is that cool?
That's very cool.
Yeah. See, the thing about calling the top, it's not about bragging rights at a cocktail party where you can say, hey, I knew it was going to stop right there at $40.58. No, it's about the money, honey. It's about capturing the movement of the stock. And look, that's what we end up doing. We've ended up, by using the income methods, income method number 6 captures the down move here, and income method 4 captures the up move.
Right.
Kind of cool, okay? When I talk about the income methods, most folks think about covered calls, and that is obvious, okay? But selling covered calls limits your upside. During this journey, Mike, if the stock had gone to $75 a share, even with the bear call spreads in place, would it have been a good thing?
Sure, right?
Glory, hallelujah. It would have been a great thing because I'm long on the stock, and the bear call spread doesn't limit my upside. It allows that winner to run. If the stock wants to go up, I'm not capped at, hey, you got to sell at 35, baby. Yeah, you got to sell at 35, but you also own a $40 call that you've been paid to own. With the stock way up high in the stratosphere, then that would be a good thing. Okay, so we had unlimited upside potential, but we were still able to take a credit. Kind of cool. There's a slew of ways to do this, folks. I'm only showing 2. I'm showing the income method 6 and income method 4, but both of them left the upside open. Okay, Mike, how are we doing on time? Because I know that folks have got some
1 o'clock,
like
Kurt.
Answer. We're right there? Okay. Let's go ahead and take some questions.
Okay. Well, let's see here. I did have a good question I was holding on to there. I'm sorry, I just lost it. Anyway, okay, well, Rick asked a question. Rick is a blueprint owner, but he wants to know, but how often does your stock really run? It seems like a pretty low percentage of the time stocks really take off unless you use a volatile stock, which doesn't seem to be preferred to have the lower risk. Now, my experience is that I do stumble across stocks regularly that move up, but I'm not talking in a 10 or 12-day period. It can happen. I mean, Kurt, one of your first trades that I joined you with, the GMCR trade, that thing popped up, what, 28% in a 12-day time period or 15-day time period, you know?
It was
that
8 days,
happened.
actually.
8 days, I'm sorry. 8 days, I'm
yeah.
sorry. But, you know, those can happen. But in general, what I'm looking for is a position that I feel is going to move up 5 to 8 to 10% within the next 30 to 60 days. Now, am I right? No. Any of you that follow Fusion, you may have seen a new trade that was released in the Fusion portfolio for a stock WNR, Western Refining. That was one of my choices, a lower price stock that I'm in it, actually in it. It moved up 3%, 3.5% within the first 10 days, but now it's pulled back and it's down actually about 6%. So I'm still expecting longer term that it's going to move up. But the key is what the blueprint teaches us. The examples that Kurt's showing here, these are selected examples, some recent, some older, of positions that illustrate some of the bullish income methods. One, we discussed 6, we discussed 4, but the blueprint teaches, you know, if my stock stagnates, well, I have 3 choices I can make. We kind of showed one of them. I might be able to use 6, I might be able to use 7, I might be able to use 8 or even 5, Kurt. If the stock stagnates in the first 20 days, I'm afraid it's not going to move. If the stock falls, well, I might be able to use 9, combo of 9 and 1, a combo of 9 and 6 perhaps, or maybe just 6 by itself. And you've recently shown, of course, there are multiple market conditions where you might be able to use that income method number 11 trade as well.
Right. The one of my favorites is General Mills. General Mills, I bought the stock, bought a put option, and I sold the bear call spread. General Mills went down 11%.
Mm-hmm.
I had a gain of 0.1%. Now, a 0.1% gain isn't something to write home about, but then again, it's better than you could get with, you know.
You were long stock the entire time, and the stock dropped down by 11%. Yeah.
Yeah, and then of course having unlimited upside during that. You see, what's the big deal? Well, the big deal is sometimes you'll hit serious winners that go out of the park, and the reason that you've got the money to put into those ballpark winners is that you haven't lost too much on the losers. You know, you can make a series of modest gains and take a few modest hits, and then every once in a while hit that home run. But if you hit the home run, it's because you haven't lost too much on a whole bunch of more than modest losers. The income methods are used to reduce the break-even. Mike, before we looked at the situation, and it was $38.95 to get into the stock, $2.90 to buy the puts. That's $41.85. And most people say, well, you can't make a dime until the stock goes to $41.95. Mike, did the stock go to $41.95?
No, it did not. It did not reach that price, did it, Kurt?
No, and yet we made 16 dimes. By using the income methods, we were able to capture the fluctuation in the stock's value. It couldn't possibly have ever lost us more than 4.4%, and ended up gaining 4.2, but along the way became bulletproof. That's what's exciting. The income methods reduce the break-even. If the break-even here was $41.85, well, using income method number 6 reduced the break-even some. Okay, and then sometimes that gap goes from large to small, but repeated applications can make that gap go to negative, meaning that our net cost for our stock and our put is lower than the strike price of the put itself. So we've got a guaranteed gain and still unlimited upside. Okay, now I showed a really modest example because I like to show modest examples. But there have been times where, for example, Mike, I was long on Marvel, which has been absorbed by the Disney company.
Right.
But Marvel, based on the stock and the put and the income method adjustments that I did, based on all the expense that I put into it, and then when it returned to me, guess what? It was bulletproof for most of its existence, and it ended up returning 30.2%. In a 2-month period. A lot of folks don't do 30.2% in a year, but because I was sitting on a winner, okay, that was a happy way to go. Okay, All right. So what had been the problem? The problem was that we could purchase the RCI stock at $38.95, but we'd have no guarantees if we did that. Okay. If we stayed in the same time frame that I showed, we'd end up with a loss of $374.
Mm-hmm.
So how did we solve the problem? Well, we solved the problem by building a fence around the stock with options. We made it so that we couldn't possibly lose more than 4.4%. We paid for that insurance policy using one of the income methods. And then finally, by some of the management techniques, we ended up locking in a better price, and on the way out, ended up with exactly the same amount of profit as if we had called the top.
Mm-hmm.
Yay! Pretty cool. So here's the accounting. I promised this, and I'll go ahead and do the accounting. We'll take a few more questions, and we'll go ahead and wrap her up. Okay? Accounting is this: after doing the put option and income method number 6, the $38.95 for the stock. Remember, we spent $2.90 for the put, and also took in $3.30 for income method 6 the first time. So it ends up being a 40-cent credit. So instead of $38.95, it's $38.55. Then, in April, we had to manage this that bear call spread, so it cost $4.66. But then, of course, we pulled in another $3.50 from a second application of income method 6.
Yes.
Okay? And then income method number 4 takes our put option from the 40 strike to the 45 strike. Costs us $3.70 to do that, but it guarantees a $5 higher strike price. So pretty cool. When we get assigned in May, we're able to sell that July $45 call for $10. And of course, we bring in $35 because the $35 call has been sold, right? Okay.
Right. Mm-hmm.
So we end up with a net profit of $1.59. Okay, or 4.2%, same as if we had held the stock and been really smart. So what? So you can lock in a price. You can even bulletproof your stock. What's the big deal? Well, the big deal is that every now and again, you are going to pick a serious winner. Okay, Marvel's just an example. Another one that I did was Netflix. Another one was Chipotle Mexican Grill. Mike, you had Silver Wheaton. Okay, all double-digit gains that we're able to realize because of being modest with losses, and sometimes even being able to get some modest gains, but always be protected. Okay, all right. Let's go ahead and take those questions, and I'm showing up there how to get a free 2 weeks of power options to everybody.
Okay. Yeah. We had another a question come in regarding the webinars, of course. I guess the customer may have come in later. So yes, you can view our archived webinars at any time. Just go to RadioActiveTrading.com and click the free webinars tab. There's also a lot of other powerful information there too. You can check out Kurt's blog, his recent posts, the Trade Simulator tool, very powerful little tool there, so you can kind of compare, what is your trading plan going forward and what might that look like over time compared to what it might look like if you do end up, of course, properly limiting your risk and applying the proper management techniques. Caesar wanted to know, how far out in time do you buy the put, Kurt?
About 6 to 8 months, minimum of 5 months. I normally don't go more than that. That's a very good question.
I found on average,
not only why, not only what we pick, but why.
Yeah. I find on average, I told Cesar I found on average that mine is 210 days to 240 days, but sometimes I'm short, 160, 180 days, and sometimes I'm longer. I'll go out and use the leaps, 400 days out in time in some cases right now.
Right. My very first RadioActive trade, I actually picked a leap.
2-year out leap, right?
Yeah, it was 26 months away. It was 2002, and I bought it was October 2002, and I bought the January 2005 put option on Amazon. What was cool was my net cost basis for the stock and the put was less than $25, and the stock went to $64 in that time frame. Right. So that was one of my most exciting trades. was my first. Kind of cool. Other questions?
Most of it was some of the other blueprint questions. Accessing income method number 11 for the older owner of the blueprints.
Yes. Yeah, if you own an earlier version of the blueprint, there are updates available to you. We have a database of all the folks that have bought the blueprint. When I first started selling the blueprint back in early 2000s, I told everybody, hey, look, you'll get updates for free. And we've honored that. And the updates are available if you are a blueprint owner. That's good news, because if you pick up the blueprint today and we come up with an income method number 12 that we've proven with real money and real case studies, we will forward that information to you as well.
Okay. Chris,
we're trying to improve. Go ahead.
Yeah, Chris T. asked a question. Does the blueprint teach you how to pick which stocks to trade or how to pick the stock? Well, yes and no.
So list guidelines. Go ahead.
Yeah, I was going to say yes and no. Kurt discusses how he uses, what settings he uses, which are actually the default settings, on the Power Options search and on the Fusion search as well, the RPM report on Fusion, the criteria that he uses and what he looks for on stock patterns and things of that nature. I trade completely differently than Kurt. Not that Kurt's selection is bad. It's just that based on my account size, what Kurt does, I typically cannot get into these $60, $70, and $80 stocks that he sometimes gets into. So what I end up doing is I tweak my searches. Now, really what it boils down to, Kurt, and we talked about this, so I can give this away to free, you can use Kurt's technique, and it's his selection process, the default settings, but you're going to want to change those settings to match what you want. What you're looking for is properly setting up the married put position within the guidelines of limiting risk in the time frame to match the three core principles. But what you're effectively looking for is you're looking for stock that you feel is going to move up maybe 5 to 8% in the next 30 to 60 days and has the potential for larger growth. That's what we're talking about here.
I'm going to do just a quick poll here, and
Sure.
The reason why is to really answer that question. The question was, do you show how to pick stocks? Well, I show how I do, but the thing is, the value of radioactive trading is not the stock picking. It's not the stock picking. It's keeping on top of your account to where you don't allow your losses to become big. You know, we showed a setup where you can get in with a 4.4% possible loss. That's the biggest loss you could take. I'm just going to say look back in time and using your stock selection criteria. Okay, if all of your plays last year, the ones that lost you money, if the loss was reduced to 6% or less of the play, and you diversified enough that each of those plays was really only like 1% of your account, okay, would you have had a better year? Would you have had a better year? Think about that, and just give that a Just give that a moment's thought, okay, and let's close that poll and share the results, okay. 17% said I lost overall last year, but would have won if I'd have done that. 33% say I might still have lost, but I would have lost much less, and 67% said I would have been one that said I'm very happy with my trading. Who said they were very happy with their trading before?
I think it was 0%, wasn't it? Yeah.
Nobody was in the very happy category, okay? So so from 0 to 2/3 of our audience, yeah, okay? And what do you think about this? What do you think about spread trades that take a credit, right, but don't cost you anything if they go against? If they go against, it's going to be a either no loss or a lower loss than if your stock had gone down, okay? What do you think of that? You know, a lot of folks that are trading covered calls would love to still have upside this past year. You know, there's a lot of stocks that went up. So, very cool. Okay, Mike, it's about 1/4 hour. I guess we ought to close her there.
Yeah, one last thing. I'm sorry. Yatish sent a question, and I was answering it, and then I accidentally deleted his question before I hit send, so I think it got lost. Common question we get, Kurt, is can I use a leap call instead of the stock? You can, but I don't recommend it. Yeah, we're going to say no, but you can, but I don't recommend it. When you do that, you create
do a whole lot of things.
You can do a whole lot of things. I don't recommend it. When you do that, you create what's called an in-the-money long strangle. when you have the long, you try to say, okay, well, they're opening this married put, stock in this put, let me take out the stock and add an in-the-money long call and still use the same in-the-money put. Now you're in an in-the-money long strangle, which behaves poorly compared to the married put in 90% of the market conditions, maybe 85 to 90% of the market conditions. And I have 2 white papers on that. I'm going to email them to Yatish so he can see those comparisons that we've written when this question has come up before several times.
Right. In our last poll, one of the questions that came up is, "Hey, can I do that in my IRA?" Absolutely. Everything I showed today could be done in an IRA. Everything I showed, and more than half of the folks that answered that poll said, "Man, that beats the shiitake mushrooms out of covered calls." You bet it does.
Kurt, real quick, last couple of minutes here. I apologize. Kenny asked a question, what is the difference between the blueprint and the home study course? Why don't you tell them about that very quickly?
Okay, very good. I'll do that. The blueprint, you can go to RadioActiveTrading.com, and on the products page, everything is spelled out, including the table of contents. I highly recommend that you scroll through that. The blueprint is $339, and it contains all of the income methods with examples. Most of them, well, all of the examples in the blueprint were live trades done with real money. Okay. Now, the RadioActive Trading Home Study Kit includes the blueprint, but it also includes 6 CDs, which are recordings, not just of sound, but also screen captures of Mike and I walking you through all the principles and techniques of the blueprint, but in a multimedia format. Now, here's why that's cool. First of all, some folks, it really just sticks with you better when you have more than one sensory input, right? But then you can still go back to the blueprint for reference when it's like, man, I'm thinking of doing an income method number 5 trade, and I know Kurt said you could get paid twice, paid when you get into the income method 5 and then paid when you get out of it. But how does that work again? And then you can just find that chapter in the blueprint, and it's it'll remind you of the presentation that you saw. Does that make sense?
Yeah.
Yeah. So that's if you find that you learn in a multimedia format like what we're doing right now, with the webinar, then the CDs would be very good addition. But I'm going to say it's a really good idea for you to have the blueprints. If you just got the CDs, you can. Okay. If you just got the CDs, fine, you can do that. But it's less easy to go back for reference than if you have the blueprint also. And since everything's covered by a money-back guarantee, I would highly recommend that you pick up the home study kit if that's your deal. If you're an engineer type, you do lots of reading, and everything's vivid and real to you from just reading, hey, get the blueprint. It's a better value. So hopefully that answered that question, answered it right.
Good stuff. Good stuff. I think we're good, sir.
Groovy. All right. Well, let's go ahead and wrap her up there, Mike, and sure appreciate seeing your face virtually again. We'll see you on Thursday. We'll probably do a different presentation then, but until then, folks, thanks for coming. I wish you happy trading and urge you to start trading with less risk and still leave your upside unlimited.
Absolutely.
All right. We'll see you out there. Happy trading, everyone.